Hello, everybody, and welcome to the 9th session of Hubraum On Air, where we're going to talk about successful exits explained. I'm Julia from the Hubraum team, and I'm your moderator for today. Hubraum is the technology incubator of Deutsche Telekom, and while we are running various incubation programs with different technology focuses, we also do have an investment fund. And the managing director of that investment fund is here with me today, live from our Berlin campus. Hello, Florian Steger. Nice to have you here.
Hi, Julia.
Hi. Florian was one of the first investment managers at Hubraum and shaped the development of our investment activities from the very beginning. You have invested in one of our best performers, such as Contiamo or Uberge, but you have also successfully exited, for example, Contiamo, Blinkist, and recently Flexperto. So needless to say that for today's Hubraum On Air topic, you're the absolute pro to talk to, and I'm very happy to have you here as my guest and to have all your valuable insights with us today. However, I'm delighted to have two more guests and experts in that field with us here today, and one of them is Min-Sung Sean Kim. Hello, Min-Sung.
Hi guys, what's up?
Hello. Min-Sung has worked as an investor in the health sector for almost a decade, as an investment director at the Samsung Catalyst Fund, as a venture capitalist at Allianz X, and currently as managing partner at Digital Health Ventures. It is very great to have you here today.
Thank you for having me.
But last but definitely not least, I want to welcome Felix Anthony to the round. Hello, Felix.
Hi, Julia.
Hello. You are the founder and CEO of Flexperto. That was, as mentioned before, one of our investment startups. And you just had your exit. So without taking away too much for now, I do want to say congratulations. I'm very excited to hear all about your journey and the insights you're going to share with us for your exit. But for now, let's groove into the topic and let's look at the title again, which says Successful Exits Explained. So, Min-Sung, the mic is yours. What is a successful exit to you?
Well, first and foremost, I think, what is the definition of an exit? Exit is a liquidity event, where the investors get their money back, the founders get their money, employees get their money, and the company is basically getting sold. Or let me put it that way, there are like 3 different types of exits as well. So the first one is the acquisition, the typical acquisition that we will probably hear, like for instance of our portfolio companies, Teleclinic. They got sold to Doc Morris, or in Germany we say zur Rose Group in Switzerland. Then there is an IPO. Back in my Allianz X days, we invested in a telemedicine company, a late stage called American Well. They IPO'd last year. So when somebody goes public, I think it's also an exit event. And the last one is basically a secondary transaction where, let's say, a VC investor said, okay, I've been there very early on. I need to divest my fund. So let me sell my shares in that company, and the next growth investor is taking over the shares. So these are like the 3 exits. What is a good exit? Just personally, I think first of all, I think you need to understand that there are like four to five parties involved in an exit. So you have the buyer, you have the seller, you have the investors, then you have the employees, and then consultants, lawyers, etc. When every group of these I think this is a successful exit. Sometimes it's very difficult to achieve this actually, because sometimes you have like terms from growth investors that have a different liquidation preference where not everybody gets their money back. As a financial investor, I would say what is a good exit is basically when you have like a 2-digit multiple on your investment made. So for instance, with MySugar, it was a very good exit. So we invested in 2014. And after only 3 years, which is very untypical, the exit event happened. We made a 2-digit multiple on that investment. The buyer, Roche, is still using MySugar. They integrated into their company, and they're using it as a digital health unit. So strategically, it was a very good acquisition. The sellers, the founders, super happy. I think it's safe to say that this was a cash deal. People were actually, the team was very happy to give also the money, some of the money to the team. It was a very good thing.
Florian, would you agree with what he just said, or do you have anything to add to that?
Yeah, absolutely. I mean, a good exit is basically where every party that is involved in is happy, right? And gets their fair share, basically, of the return. I think what's important to understand from a founder perspective is that somehow if you start building a company based or financed by venture capital, you're somehow getting automatically on a road towards an exit. So that's really somehow not clear to everybody, because we all know from like our private life and financing, the type of financing where you go to a bank and get a loan, for example, if you want to buy a car or a house. But that's a totally different, basically, system. How I pay back in the end the investor. With a loan, actually, I pay back that loan every month, for example, with a certain interest rate, because I have savings, right? I have a house now, I don't need to pay rent anymore. I have a car, I don't need to use as much public transportation, or I can get a better job. So I have earnings, and out of those earnings, I can pay back that loan. If you take money from a VC, that's part of what we call private equity financing. You're not getting a loan, you're actually selling a share or a part of your company to that investor who gives you the money. And the way that investor is actually paid back and gets his return is in the end by selling the company, especially when it comes to a company that is growing a lot and that has not the ability to create profits or great free cash flows in the near future. Out of those where they could pay back the investment. So really, if you take venture financing, part of the business model of those investors is at the end to at least sell their share in your company. And this is why you should think automatically and from day one, basically, what you can do to have an outcome to really make this a good exit for every party that is involved.
Yeah. That's very interesting. I sometimes ask myself, and many others have maybe also, why sell when everything is going fine? So according to your answer just now, it's because you kind of have to in order to make the investors happy, or is there another way?
I mean, there is, as Min-Sung mentioned, there are different types of exits or different way to sell your company, right? So it could be that you sell your company completely 100%, every shareholder, founder, investor, sell it to a mostly like another company or maybe another investor who takes over the company fully. So that's one type of exit. The other type of exit could be that only the investor sell their share to another investor who is more orientated in late stage investments, and you as management or founder keep your share. And in the end, there's the possibility of an IPO. If you're really successful, you can go to the stock market and also sell a part of your company fully. But again, if you go on that road of taking private equity type capital, venture capital, like automatically the business model of that investor is in the end to sell his share in your company for a profit. That's his business model. So it's not a matter of like to make someone happy. It's simply the business model of the investor that you are working with.
Yeah, okay. So before we dig deeper and get more of your expert knowledge on this topic, let's give the mic over to Felix, who has just recently had his own exit. So he has his very own story to share here. And I would be very happy if you, for our audience, really quickly introduce what Flexperto actually is, what you are doing, and then we jump over to the actual whole journey of your recently fulfilled exit.
Yes, sure. Thanks again for having me. And this is quite new, everything. So we just had an exit, we announced it 2 weeks ago. So everything is still quite fresh. Flexperto, I founded in 2012, and it has become today's, I would say, Germany's #1 platform for remote sales communication. So today, we have over 100 enterprise clients that use Flexperto to enable their sales agents to sell and service their customers remotely via video chat, via instant messaging, via collaboration tools such as screen sharing, co-browsing, to sign contracts digitally, to schedule meetings. So it's basically a platform for digital consulting experience. And our main customers are banks, insurances, today we're a profitable business, very fast growing. Last year we grew over 160%. Hubraum was actually where we started. So where you are sitting right now is actually like where we had our first funding party back in 2016 when Hubraum invested in us.
Yeah, Florian, you look very proud of this. So congratulations again from us. And yes, it's very fresh. That's why we haven't announced you for the longest time. But now finally we can talk about it. So please tell me, what was happening? Like, was it a goal from the very beginning on, just like we talked about it before, that you were going to have an exit at one point? Or how did everything happen?
Yeah, so as Florian said, like when you raise money from VC investors, from venture capital, then you basically already decide to go this route to a potential exit in the next, let's say, 5, 7, maybe sometimes also a bit longer years. Obviously, like what Florian said is right. When you take VC money, then you have to be aware of that fact. You cannot like say, no, I never want to sell the company. But you need to be aware that this will happen at some point. And then it's just a matter of the right timing. So for us now was the right timing. We've grown very fast in the last year, and we were very happy with our VC investors that we had on board so far, but we were looking for the next level. So for us, it was not the case that we just wanted to exit to go out as founders, but we wanted to stay in the company to bring it to the next level. And therefore we had to change basically the shareholder structure, but at the same time, we also wanted to have a cash event also for us to get some liquidity in also for us as founders.
Mm-hmm. So share with us, how is life during and before the exit? How exciting is it and how stressful is it?
So the funny thing is, I was most of the time doing like the M&A process, which took roughly a year. So mostly M&A advisors tell you like 3 to 6 months or maybe a bit more. So it usually takes a bit longer, especially if you buy it or if you're selling to a strategic buyer. And we sold to a insurance software vendor, which is basically its business, our core insurance system. So very traditional software business. So it takes a while. And the funny thing is, like, I was most of this M&A process, I was in South Africa, in Cape Town, where I have a house. And I'm basically also sitting here right now. And in fact, I had a lot of meetings. Like, it was a very stressful times. I worked long hours, and like we had calls with M&A advisors, with the lawyers, even at 12, 1 o'clock in the night. And like, even the day before, like the notary meeting, we still had like surprising facts coming out with IP rights and whatever, you know. So there's so many things that basically the buyers dig into doing the due diligence, that it's really an emotional roller coaster. So it's not only like stressful times in terms of work, because like obviously, especially if you're a smaller company as Flexperto, you still have to run the operations. So that's why also it's important to think about the exit well before, because you will spend additional time on the process. For instance, I never met our new shareholders in person. So it was a complete remote process. I also didn't go to the notary in person.
That's all because of the pandemic, of course, right?
Yes.
Okay. Special times.
This is it's actually incredible. Like, it was a complete digital M&A process, let's say, except like the notary meeting at the end, which was then carried out by our lawyers. And obviously the day it was signed, it felt very unreal. Since I didn't sign anything. So there was the signing, but I didn't sign anything. And I didn't pop the champagne like in the notary board room or something like that. So I was sitting here in my office in Cape Town, just by my own, and finally got the email. It's signed, and so obviously we still had a big party here, but
Okay.
it was different, I think, now in terms of the crisis than it would usually
So
happen.
it is just like they say, it's the most stressful thing you can ever imagine as an entrepreneur. But during the pandemic, only the parting of the success is slightly different from what we know before. You just mentioned it yourself that you need to have the right timing for an exit. So I want to dig deeper here. When did you know that the time had come? Can you explain that a bit further?
Sure. So it depends on multiple circumstances. So it depends like on your shareholder structure, on their timing. It depends on your personal, personal goals and your personal situation. It depends on the business growth. So there are multiple parameters that basically can lead to this decision for us and for me personally. The main reasons why we decided to start the sales process was that we wanted to bring Flexperto to the next level. So we wanted to become more international. We wanted to have more money, let's say, to invest in growth, to also have inorganic growth, so to grow by acquisitions. And this wasn't really possible with our existing shareholders, because like most of them already invested all they had basically, and on the other hand side they didn't have the experience to foster this growth that we were seeking. So this was certainly one component, and this was the main driver to start the M&A process, so that we said we want new shareholders. But at the same time, we also obviously on a personal level, after 7 years of doing Flexperto, and the first 3-4 years, it was really hard. We didn't have any big revenues. Like we were still giving everything every day, and we didn't have any success. And like finally we were successful and we were growing very fast. And at some point you also want to harvest a bit. And that was a point for me from a personal level that I said, okay, I want to gain some security now that I turned 30 years old. I want to, for me personally, to gain some security by also having some cash, basically, right? As easy as it is, to also diversify my personal risk, because my bank account basically had like 5,000 euro in it, and this is not enough for like your retirement plan, let's say. And even though I was quite fortunate to have a good salary and everything, I wanted to diversify my risk a bit more, and that's what I did then. And so these were the two main drivers: having a different growth with new shareholders, and getting some risk off the table and diversifying.
So maybe if I can add to this, because I really think Flexperto here is a quite good example. So I think, I mean, you need to make a decision that you are striving for an exit at a certain time point, and be aligned with the shareholders and the management about this. But in the end, you cannot really force it, right? So basically, you have to bring yourself in a position. You need to have a strategy, but then you also need the time, basically, to wait for good offers, to collect offers, and also be aware of the possibility that maybe there will not come an offer that is attractive enough for you to really go for the exit. So if you have then focused all your energy and like every minute of your day into trying to achieve that exit, you may have, or like you may end up not with an exit, but with a really bad business because you didn't focus on your business anymore. So I think what Felix did and Flexperto was really good, and something I can recommend, that he from early at that point in time when he felt now it's going in a direction where an exit could be a possibility, he basically tried to align his co-founders, the management, the investors about that, had a clear strategy, brought the right people on board, advisors, etc., to push this, but did really also grow his business in the meantime. And we always had the possibility during the process, even a week before the notary appointment, to say, hey, no, if this goes in the wrong direction, we could still leave it as it is, right? And have Flexperto in the same setup like before and would still have been growing. So I think that helps you obviously a lot to get the right offers and get to that successful exit.
Yeah, I think handing over here to exit negotiations, I think what you just mentioned is also not to force it too much, but also not seem too desperate, right? What are other advices you would give to colleagues, to startups when it comes to exit negotiations, and what are the do's and don'ts here?
So what I really found out myself, I mean, I've been a founder before I became an investor, and also sold 2 companies. I founded myself, and I did it all on my own. I think that's somehow more or less what like the default mode of a founder is, to do it on your own and to figure it out. In this case now, as an investor, I've really made the experience several times. There are experts and advisors, in that case M&A advisors, who do nothing besides exits, right? And even if they cost a lot of money, they're absolutely worth it. So if you are going for an exit, like at least when you go for a substantial amount, look for the right M&A advisor with the right experience in your area, in your industry, the type of company that you are selling, and basically contract him to guide you through that process, to guide you through the negotiations, to get additional offers. Maybe even if you already have a potential buyer, he can then go out to the market and see if there are not 2 or 3 more offers that may increase your valuation and the price. So I think that's really worth it, and this is something I've learned now in the past few years, as from an investor's perspective, seeing more exits, that these type of M&A advisors, if they are good, obviously they are good and bad, like in every industry, but if you find a really good M&A advisor, I would definitely recommend to do it.
Okay, interesting. Minsung, what's your take on that?
Oh, I think like, raising funds for the growth round at the same time, talking to M&A advisors, I think it's a pretty good thing. I think first of all, you are others, first of all, most trying to get the growth round together. You are probably hopefully in a very good position. You're not running out of cash in the next, let's say, 3 months or so. Yeah, you have a long runway. You're talking with growth investors, but at the same time you're talking to strategic investors, and you need to basically, like, you don't need to start 100% at the same time, right? I mean, I think what is really interesting is basically that when you sell only half of the company, and then negotiate basically a variable price where you can work towards certain KPIs. If you reach certain KPIs, then the valuation of the company goes to a higher certain point where the strategic investor has the option to buy. So this is also kind of like when you sell your company, to actually gain much more out of the exit rather than getting now 100% of the exit price.
Felix, I think you just wanted to add something before that. What is your experience with those negotiation strategies?
Yeah, first of all, I strongly agree with what Florian said. At the beginning, when we started the process, we were also like, do we really need an M&A advisor? Like, he costs so much money. And what is he actually adding? He introduces us to some people and then we have to do the rest, right? So that's what we thought. But it turned out that actually our M&A advisor did an incredible job, and he had a lot of things to do. So it was really worth the money, and I would always recommend it again. especially because like it's hard to negotiate yourself. It's better to have someone, even if you're a great sales guy, it's better to have someone, an intermediary who can be less emotional because you're emotionally involved in it. And it's better to have someone who does it for you. It's the same with the contracts. You don't want to destroy a relationship by having hard fights about the contracts. Let the lawyers do that, right? So I agree with that. And I also agree with what Min-Sung said. Timing is important. So within the process, we always overachieved our business plan. So obviously, like they will try to give you an indicative offer, and then if you don't, and then they can easily prolong the process by just being slow, right? And if you then not having like 10 different options on the table, but maybe only 2, and maybe like one is even not as attractive, then it's important that you are in a position of strength, and that you can basically, instead of them saying, now your numbers are not as good and maybe we should talk about the price again, that you can actually say, oh, like actually, like we wanted to do the deal 6 months ago already. Now our MRR, our recurring revenue, has increased by 50%. So we need to increase the price as well, right? And so that's it. It's the same like if you're raising money in a fundraising from a venture capital firm. You should always bring better news during the process than they had at the beginning, and surprise them in a positive manner. But obviously, like for us, it worked out, but I guess not every founder has this possibility, because there's obviously also cases where people are selling because it's not working well. And so this is the recommendation. Only if you have the chance, don't lose focus on your operations, because you need the sales, you need the numbers. It's more important to do the customer meeting than to do the meeting with the investors.
I think just one thing to say here, basically, to bring it on the point is basically always talk to several potential buyers. Don't only talk to one buyer, because this will actually fall on your valuation. Because when you talk to one buyer, you can, or when you have an M&A advisor, even better, he can always say like, oh, you are in the process and we are negotiating with different buyers about the price. So basically, there is like a kind of like a competing event where the buyers have to basically come up with a very good offer, so they win the tender. The other thing I think what Felix is trying to say is also about cash, about runway. Now, when you are negotiating with, let's say, with a potential buyer, and you say like, okay, my company is worth 60 million, you need to put 60 million in cash on the table, otherwise we won't sell. And he's just waiting for, let's say, 3 months or 6 months, and your company goes bankrupt. Then he can buy the company for maybe like, I don't know, 1 million or 5 million or so. So I think the cash is king, and cash is super important strategically, not to be too desperate for your buyers. I think like these are like the 2 don'ts maybe to bring it down.
And also you need to look at to whom you want to buy sell, right? So if you're selling to a strategic buyer, then they usually expect like profitability, right? So sometimes it's then worth to first turn your company into profitability before starting an M&A process, which we, for instance, did. So we were on a track to profitability in that moment that we started the M&A process. And during the M&A process, we could show that we had like EBITDA margins above like 20%. And obviously, this is something which shows a certain maturity of your business, which is important for strategic buyers, which might not be as important for a VC case. But if you sell the company, profitability suddenly becomes important. So, and that's I think also something to look at.
You're right. I think one of the things is basically that strategic buyers are also very looking much. Usually, they don't just buy the company when they're not profitable 100%. They usually like, just take maybe 25% or 25.1% or 50% first, and then basically say like, okay, if you reach the KPIs of next year, we will buy the whole company to see if it's profitable. I think, this is also one of the reasons the company really, doesn't want, or the buyer doesn't want to buy your company, and then everybody's leaving the company, and you have basically a hull. Yeah, especially like in startups, it's about the accumulation of talent that comes together working on a new tech product that the buyer, usually the corporate, cannot really assemble so quickly at the same time. So I think like, what they really like to do is like having the management team still on board, and this is called earnout, right? I mean, I'm not quite sure, Felix, do you have an earnout?
No. We are
so that's a
like,
cash.
we're out.
So you had a cash deal.
No, but like we reinvested in the buyer. So obviously like this also gives the buyer a lot of trust that you want to work with them. If you like in our situation, it was a private equity, it's Corsair Capital, which also I think have a majority stake in ID Now. So they basically finance this acquisition. And so basically we as a founders, we reinvested the majority of our proceeds into the buyer. So Flexperto was sold to 100%, and we don't have like any strong burdens there or earnouts, which I think wasn't so attractive for us. But
no, I think like, but still, I mean,
nice thing.
But a cash deal is very, very attractive, I think, especially to fund. I mean, I'm for instance, the My Sugar guys, they had also 100% exit event, liquidity event, and they are now investing in other companies in digital health, which is pretty cool. So for instance, they're helping the ecosystem to grow. Back then, when they started in 2013 or so, or 2011, digital health was, there were no companies in digital health. Now, some exits, and these entrepreneurs, they're investing back in the space. And I think that's a wonderful thing. Also for you, I think, diversifying yourself. Now you can back early entrepreneurs in the tech ecosystem, and diversify your risk, as you mentioned.
Yeah, I think maybe to add one point on the timing, Julia, and you interrupt us if we're talking too much. I think, like we said, you need to be profitable, but like not mainly experience, but like what I observed is that if you for too long time profitable, then it also bears the danger that the buyer will value you on the EBITDA multiple, right? And so this is another topic about like how the valuation works, right, in an exit event. And so like for me, I figured it's actually quite nice to just turn profitable, so to avoid that they value you on your EBITDA, but still show them that you can become a very profitable business and show them a track record with that.
I think I want to go back to the topic of challenges you faced during exit. I think we mentioned quite a few already. It's about psychological strength. It's about endurance, making sure that your operations are still running smoothly. But from a buyer's perspective, what are challenges for them, Florian?
I think as a founder or manager of a startup, you need to be aware of that. Most of the buyers of those kind of transactions are not only buying the organization of a company or a technology. It's always the combination of what you have built, and that's a product, that's customer relationships, but that's already you. But that's also you and your team. And it's very rare that actually the founders basically like immediately after the exit need to look for the next job or the next venture, because mostly the buyer tries to bind somehow the existing knowledge of the team to what he wants to build now. And this can come in many different ways, how they incentivize and basically try to give you motivation as a founder to, at least for a certain amount of time, to stay with the company. So I think that's what you need to be aware of as a founder, that this is totally normal, right? You cannot go around it. You need to stick with what you have built for a certain amount of time to integrate it. but there are different models how you can do it. And obviously this is always a big part of the discussions, because if you want to get out earlier, you might actually decrease the valuation of your company, because then the buyer is saying, oh, okay, if they are not involved anymore, I cannot be absolutely sure what's going on here. So it's always a discussion then, how early can the founders get out, the management team get out, and does this have any impact on the valuation of the company and the exit price?
Mm-hmm. What's the strategy here for you, Felix? I mean, you mentioned already that you're going to stay, of course, but how exactly did that happen?
Yeah, so I think that's one of the main assets that you have as a founder in the negotiation process, because like you're not only negotiating with the buyer, but you're also negotiating with the other sellers. Because obviously at the end of the day, like all shareholders want to have the maximum portion of the cake. And so if you are as a founder still very much involved operationally, then it obviously strengthens your position in the negotiation, both internally as well as externally. That's why you shouldn't forget you're not only negotiating externally to get a bigger piece of the cake, because like obviously you as a founder, you are there to stay, and you have to stay often, or you want to stay. You will drive the business. You give the buyer the certainty that they will that the business will flourish in the next years, because they're not buying you to shut you down usually. Whereas the existing shareholders, they're just out, right? They don't have anything. So it is also often not fair that everyone gets the same share. But it also makes sometimes sense that the founders, and I want to motivate the founders to also discuss that with their existing shareholders, that they get a bigger share than they would maybe have on the table.
Mm-hmm, mm-hmm. Would you agree with that, Min-Sung?
Well, I think like, you know, when you look at, I mean, there are different buyers, right? I mean, you have these private equity firms, usually smaller teams, and then you have corporate, strategic buyers. And I think like in a corporate, not everything is like return driven, financially driven. And like in corporates, big corporates, there's also a lot of politics, etc. So when you look at from the corporate side, I think there is a before and an after. So before, you need to align basically with all your business units and who is taking responsibility for it. Yeah, so basically, like this is a very difficult thing. You need to find business units that want this acquisition and want to work with it later on. Yeah, the post-merger acquisition. And I think this is something that's very challenging for the corporates to integrate a startup into the corporate structure. I think that usually you need to have these people stay on board, because you know they cannot just leave you a hull there. The other challenge that a corporate buyer has, or I think every buyer has, is that there is a limited time frame where due diligence needs to happen. Yeah, so when you have an M&A advisor, he's basically giving you like a timetable or time frame, like, okay, here you do the due diligence, here you have to give a term sheet, this is the time frame for term negotiation, etc. So before the deal, you really need to find all the red flags. You need to find in the limited time frame. You need to dig through the due diligence room, through the data room, and basically find like, okay, and you need to find the founders. You know, you look on Glassdoor or Kununu or something. Is there any sexual harassment cases or something like this? Yeah. But I think one of the major challenges is basically when you are almost done with the transaction. I mean, for instance, when you have a late stage deal, you're about to invest, I think, let's say 40 to everything is done. Due diligence, all the due diligence streams are ready, you know, financial, tax, etc., commercial, tax. But then legal DD shows there is a red flag. Or let's say the lawyers always say orange flag. Yeah, so you can interpret it as a yellow or as a red flag. And it's so late into the process, and you have done so much work, incredible much work, and you know you really need to decide, is this orange flag strong enough that you kill the deal off? Mm-hmm. And I think this is a problem of deal teams when it comes to acquisition. The deal team, they want things to happen. They want to close the deal. But when you look at the post-merger teams and who have to basically deal with all the consequences and all the aftermath after the acquisition, after the ink is dry, this is basically problematic for them. Yeah? So I think this is like basically before and after. I think you need to basically take it into account of what kind of challenges the buyer has.
All right. We do have a question from the audience, which is quite interesting. It says, how do I determine my exit strategy and what leads me to my proper route? I would forward that question to Florian.
Exit strategy. So I would need to ask the viewer what he means specifically by that. But so I think we've mentioned a lot already what the different type of exits could be, and I maybe want to give that answer that you cannot, like I said before, like you cannot force a certain outcome, right? So I'd say the best way is actually to set up different strategies in parallel, looking for a strategic buyer. It could be, as Min-Sung said, it could be someone who is already your customer. It could be someone you know as an investor. It could be that you find someone over an advisor. So I think it's like really good, obviously, to focus on the ways you think that work out best, but be open as much as possible to different kind of scenarios.
Mm-hmm. Okay. And we have another question that is directed. Do you want to add something, Min-Sung?
Yeah, I really would like to add something. I think, you should consider an exit strategy, especially when you think that the company is outgrowing you. Yeah. Either you find a successor. I mean, basically, like, the company, if you think about Facebook, you have one CEO at the very early beginning and now each company, and it's the same CEO. This usually doesn't happen. The company sometimes outgrows your skills. As a CEO of a company, you really need to unlearn and you need to adapt to the needs of the company that goes through different stages. Early stage company, you cannot lead like a growth stage company. And when you realize that you are not fit enough and you need to find a successor and you cannot find a successor, I think that's the time where you actually need to think about the exit strategy. Before that, don't think about it. Just, focus on growth, and the capital will follow. Growth, and talent. The capital will follow you. But don't think about exit strategy at the beginning. Just try to enjoy the ride.
All right. Felix, is this how you've done it? Would you agree to that?
Absolutely. Like, I mean, as I said in the beginning, like if you sign a deal with devils, let's say the VCs are the devils, then you need to deal with it, right? And then you need to know that there will be a liquidity event someday in the future. So you shouldn't be surprised then that this will come. But on the other hand side, you shouldn't start after you raised your first round and your second round and already like look for a successful exit. But you should fully focus on growth, and that's how we did it as well. Like we didn't think about like an exit, and we only thought about how can we grow quicker, how can we get more customers, how we can improve our product. And I agree with Min. In the ideal case, then the people will approach you when you're interesting enough and will tell you, hey, we would be interested to buy your company. And this is actually like the ideal stage, that you get approached by potential buyers and not vice versa. And then you also know that you're maybe ready to start an M&A process.
Looking at your exit, I'd be interested in knowing if there's anything you would have done differently that you know now.
Oof. That's a tough question. This is a really tough question.
You can have some time to think about it if you want, but I think we all want to know. I mean, there are quite a few learnings that we're talking about right now, but what is the one thing you're like, if I could turn back time?
Actually, like, it's not answering the question, but we were very lucky, like we started an M&A process when the Corona crisis started. So our numbers exploded, right? We had like times where we had 2000% week on week usage growth. So so we were very lucky. So that's why very hard to find like things that we should have done differently. Like we had great M&A advisor, we had great legal advisors. So we also did the right decisions there. We negotiated well with our existing shareholders. We negotiated well with the buyers. We had multiple options on the table.
You were really lucky then.
We were very lucky. Like there's nothing that really straight comes to my mind that I would have done differently, to be honest. But I will think about it. Maybe I will think of something.
Maybe we'll ask him in a year from now. It's still really fresh, right? So.
Maybe Florian, maybe you have watched, maybe you have experienced something where you're like, this was a big mistake. Can you share with us like the biggest mistake you could potentially make?
It's really difficult because like hindsight is 2020, right? So I mean, always looking back, you feel like, oh, if I would have done this differently. But and I mean, obviously, you will find a lot of founders who not really regret, but who tell you, hey, in hindsight, I have sold too early, right? If I would have waited, I don't know, 2 or 3 years longer, or have that additional growth cycle, there would be a digit more to my exit sum. But you're always assuming like the optimal outcome if you look back and you're not assuming additional problems. And I mean, Felix just told you that they were really lucky, if you can say that actually the pandemic really helped their business because everything got virtualized and whatever. But there are so many different businesses. If you would have been in travel business or whatever, right? And you would have waited a little bit longer with your exit that you have thought of in the beginning of 2020, you would totally regret it, obviously. So I think that's a little bit of a mood question, which is fun to talk about. But I would rather recommend to just think about what you do next and not to look back.
And Florian, and Julia, I actually have something, that I would have, or that I would do differently. Like next time, I would meet the buyers in person, even though I own a digital communication software, and I also would pop the champagne with my co-founders together. And this is like the only thing that I really, really missed out.
But it's something you had no control over. So you really were lucky and did a very great job. We have another question from the audience directed to Min Sung. What did the exits which impressed you have in common, and why or how did they impress you? So you just mentioned Facebook. I don't know if you said that was impressive, but maybe you have some more examples just like that. And maybe you want to elaborate on this.
Yeah. Good question, actually. I mean, with Facebook, I just took that as an example where the CEO is founding a company and takes the company public, and then also staying as the CEO for such a long time. Yeah, I think that is very exceptional. I think startup exits that climb up in valuation very high or very fast. I think these are like the companies that I really like to see in Europe more. I think, like, in Europe, we don't have this kind of ecosystem that we have in the United States. In the United States, the capital is there, the talent is there, and you can scale a company from 0 to hero in a very, very fast time. So these are called scale-ups. I mean, we have now more scale-ups like WeFox, for instance. They are growing fantastically. We also have, let's say, Gorillas is a very cool example. And I'm a big fan of Gorillas. I use them during the pandemic. I use them once a week or so. They have grown. I mean, when did they start? I think they started last year. Now they are already worth over $1 billion in valuation. With MySugar, for instance, I was also very, very impressed by the founders that they managed to sell the company like within, I think, like we invested in 2014 and they exited in 2017, after 3 years. And it was a cash deal for the founders. So the founders, they are pretty well off now. I'm very happy for them that we could back then contribute a little bit to help them and guide them through the process.
Maybe also to add to this, I think if you think about successful examples, you're obviously always ending up with the stories we all know, mostly from the US, mostly from Silicon Valley, because these are kind of like the perfect examples. I mean, I just read recently that when Google bought YouTube, right, I think they paid like $3 billion for it, for example, and now they are doing $3 billion in revenue every 3 days, right? So and Google added that perfectly to their business, what they are doing. But it also shows the potential of those exits, but especially of those acquisitions to the buyers. And I think that's something that we still miss in Germany and in Europe. Many more good examples of when a established corporate bought a fast-growing startup and then integrated them into their business in a way where it could strive and grow much better than it could be independently, like it was maybe the case with YouTube and Google. I'm sure we will get those cases more and more. And
what do you think are the reasons we are lacking those examples, mostly here in Germany?
Well, I think there is still a lot of that corporates in Germany are very self-dependent, right? And somehow think that only what you develop inside, basically, you have the best knowledge, you have the best people. Why should I buy them from outside? This type of corporation, like in Silicon Valley, which actually more or less only consists out of companies they have bought, right? If you look at the history of Intel, for example, if you look at the history of Cisco, these were companies that basically are put together by dozens or even hundreds of startups that they bought over time. Mm-hmm. These type of like organizations and the setup you need in the organizations to do this. Min-Sung talked about the post-acquisition teams, so really teams inside the corporates making sure that you are not only acquiring them, but then integrate them into your business. This is still something relatively new for most German or European companies. Obviously, it depends on the sector, but at least in the digital space, I think there is still a lot to catch up.
How is it in the health sector here, Min-Sung? Would you share this experience?
Yeah, I think, like, you know what, I think we're getting there. Yeah? We will see more scale-ups like in Silicon Valley. It's just because, you know, the ecosystem in Silicon Valley is like, I don't know, so much older than the German ones. You have people that are focusing on early stage. You have people who are focusing on growth stage. So you have people that have seen that a company is growing 3 times over a month. Yeah, so I think not a lot of companies have done it in the past. We have a lot of good companies at the moment. And I think these people are learning how to deal with growth, how to manage growth, how to scale growth. And these people hopefully will teach other people, work in different companies and share their knowledge. So basically, we have the ability to scale up. We are at the moment, you know, also looking into the healthcare.
I think we just missed you a little bit here. Hope you're coming back soon.
Can you still hear me? Guys, I think this is home office, you know.
If really you would difficult. Just repeat your last sentence, I think we couldn't really understand what you were saying because of your internet. I'm sorry.
Yeah, I'm really sorry about the connection and about the background noise. I think like also what is important is that you have these people that are managing growth at the moment. Yeah, we have companies that are in scale up situation, where companies are growing 3 times a month. And these people learn how to manage it, how to grow companies. They have seen it, yeah, and so they can take back to other companies here in the ecosystem, or when the next company is coming. I think this is very important for the ecosystem to produce more unicorns and more scale-ups. Because at the moment, when I look into the ecosystem, a lot of companies are still looking like product market fit. That means having the first paying customers, etc. But having the first paying customers does not mean that you like accelerating in growth, where the company is insanely growing, like gorillas, for instance, and you just need to hire people in order to maintain that growth. You have a whole different set of problems, and I think this is the thing that companies will learn over time.
Thank you for that. I think the last question from the audience is one that is very broad, but let's try to break it down to the most important steps. How can I achieve the maximum valuation for my business? Are there any advices from your side here?
Well,
Florian.
it sounds easy, having a lot of alternatives, right? Having a lot of alternatives in not needing to sell your business, right? Because it's going well. You have other like opportunities. You can get growth investment. You can grow out of your like standard business, have additional customers, but then also having a lot of offers on the table. I mean, it's as easy as that, and as always in life, the more people that want what you have, the higher you can make the price. So I think that's a quite easy but difficult to achieve answer.
Felix, would you agree with that? Is that how you did it?
Yeah, definitely. Like the more demand, the higher the price. That's what you learn if you study business, right? But I think timing is really important. So you have to think of, okay, if you have a certain growth rate and you're growing like by 60, 100%, whatever, per year, then obviously like you have to ask yourself the question, what like is my opportunity cost, right? So if I would sell now, where would I put that money into, right? Because if you are like the CEO of the best investment that you can currently have on the market and you have control over it, you know what the future brings better than anyone else, why would you then exit it? So you need to really look into the future, and I think that's what like entrepreneurs are good at. You need to look at the future, what will happen in the next years, and that's why you need to see if you're on the peak of your growth, or even if the growth slows down, it might still be good to stay on board and to not sell your shares. So it's I think a lot about like to look into, to visualize the future, what will happen with your growth in the next years, what's the market situation, are there buyers on the market currently, are people more bullish to pay like a high valuation at the moment? And then it's a combination of all these things. And last but not least, and I think that's very important, like we're talking a lot about cash and stuff, but you need to look at what you want in life as a founder, right? So if you don't feel like comfortable with like what you're doing right now, then you need to change it and not spend like any more day doing that. But then you need to start a process, because like your health and like your relationship to work and like how you feel comfortable and so on, if you can't change it in the setting you are in with shareholders, with your co-founders, whatever, then you need to change the situation. So I would say maximizing your exit returns is nice, but it's not the most important thing in life.
Thanks for these very nice last words. And I would like to round everything up with something very important, and very important fact we have to keep in mind. I found this quote from Andrew Vasilik, who is the host of Startup Exit podcast. He said, "Lastly, don't forget to get lucky. Even with all the right ingredients in place, a successful business, relationships with potential acquirers, and all fingers crossed, a successful exit may just never happen." So if you still insist on having an exit strategy, make sure you include must get lucky as one of the key steps. And I think it's very important to always have that in mind, that luck is one of the driving components for a successful exit. So this has been a very great panel, and we learned many, many things from you, from two luminaries in that field and someone who has the freshest, inspiring insights because of your latest move, Felix. So if you still are left with remaining questions, please reach out to us. We're here to help. But also, we would very much appreciate your feedback. So please click on the provided link or scan the QR code to let us know what we can improve, and also what topics we should discuss in the future. But for now, the topic of our next episode has already been decided. I'm looking very forward to welcoming you back on May 27th, where it is going to be all about IoT, or the Internet of Things. So thank you for our very awesome guests. Thank you, Florian. It was great to have you here in the office, which is during these days not very often happening. Thank you, Min-Sung. Thank you, Felix. Congratulations again. Thank you. It was a pleasure talking to you and to have your knowledge here with us today. So see you very soon. Bye.